Hi, welcome to Aja Commerce Academy. So today we'll be starting with ratio analysis. So what is a ratio? A ratio is nothing but a mathematical expression which gives a plausible relationship between the numerator and the denominator. So whenever you see a ratio, remember that the two components of it, that is the numerator and the denominator, are somewhat related, or there's some relationship between them which must be identified and interpreted. And that is done through ratio analysis. Since we are dealing with financial management, the ratios and the figures which appear in the ratio analysis are forming part of financial statements mostly, which is your balance sheet and your statement of profit and loss and your cash flow statement as well. When you look at the cash ratios and all, they're also forming part of your cash flow statement. So when we start with the solvency ratios, the solvency ratios tell you how much, that is, the extent to which the company or the entity is solvent, that is, it is able to pay its liabilities or obligations or dues. The solvency can be long term solvency and short term solvency. The short term solvency deals with the payment of current liabilities, that is, the potential of the company to pay its current liabilities. For example, you have the current assets divided by current liabilities, which is your current ratio, and the quick assets divided by current liabilities is your quick ratio, and the cash and cash equivalents plus marketable securities, which is also readily convertible into cash, form your cash ratio. These form your liquidity ratios. Now look at your leverage ratios. Leverage ratios deals with the capital structure ratios. That is, if you look at your balance sheet, you have your liabilities and your assets. So, and then you have your long-term liabilities, your short-term liabilities, that is your total liabilities. You have your fixed assets and your current assets. These form your total assets. So when you look at capital structure, what is a capital structure? A capital structure deals with the formation of the long-term debt, long-term equity, and the long-term funds of the company. For example, the capital structure deals with this. So what is this entire thing called? This entire thing forms part of your financial structure. That is, the financial structure is also considered with your short-term liabilities, but the capital structure only deals with your long-term debt, your long-term equity share capital, your preference share capital, only that. Now, when you look at the profitability ratios are nothing but your gross profit margin ratio, your net profit margin ratio, that is, they deal with the profits. For example, the gross profit margin ratio is gross profit by sales into 100. The net profit, similarly, instead of the gross profit, you take your net profit, and if you want to calculate the operating profit margin ratio, then you take your operating profit. And if you want to calculate the expense ratios are nothing but what part of the expense. See, for example, if you take the COGS, the cost of goods sold, and you have other operating expenses like your admin, selling and distribution overheads, etc., which are operating expenses, then if you want to calculate the expense ratio, COGS divided by sales into 100 gives you what part of the sales is comprised of your COGS. That is, what part of your sales is being eaten by your COGS, what part of your sales you are expending towards COGS. Similarly, the expenses, operating expenses, if you take operating expenses divided by sales into 100. For example, if this comes at 50%, that means 50% of your sales are going towards your operating expenses. So the lower the better. That is, the expense ratios must be lower so that more chunk of your sales go towards your profit and not your expenses. And finally, you look at your activity ratios or turnover ratios. The major, most important part of your turnover ratios is total assets turnover ratio. The main purpose of investing into your assets is to earn income, the income you earn through your sales or your turnover. So the total assets ratio is the turnover divided by total assets. That is the total assets into which you have invested your money, how much of the total assets is contributing towards your turnover. For example, if you have a total assets of 100 lakhs and you have a turnover of 10 lakhs, that means your total assets ratio is 10%. That is, you're earning a sales percentage of 10% on your total.